10-year note yields continue to remain stubbornly low, and momentum is really starting to build. Lowest weekly settle today, going back to mid-September when we settled at 299 on the way up. And really, since the whole debacle began on October 3rd, stocks crashed, yields started to decline. It's really been a straight shoot for both yields and equities together, and we've seen implied volatility creep up. So right now, the momentum is starting to build as we continue to press closer to that 3% level. Again, a level we haven't seen going back a few months, and it's a level that we're probably going to see relatively soon here if something doesn't change fundamentally in the market. If we look at implied volatility, yes, it's running elevated, heading into a weekend, which is rare, but also because of the fact that we've seen obviously Fed policy hasn't changed. Obviously, we're seeing mixed data that really probably wouldn't steer us towards lower yields, but has been. The equities have been the big market mover here, which has really, I think, seen the bid in volatility. It's bled into bonds. So right now we're seeing higher volatility as the market attempts to trade outside of the recent range. Once it does, obviously volatility will probably start to subside if we find a resting point, but we haven't done that yet. And certainly 3% is going to be the big level to break through. Lastly, what's ahead that could push us through 3%? Well, those November FOMC meeting minutes, easy for me to say, next week, that could be one thing. If we read anything in the tea leaves from the Fed, I doubt that we'll see anything really critical there because we've seen Powell speak, we've seen several other Fed governors and presidents speaking since then. They've all mentioned the global environment. They've all mentioned the risk of declining growth, and they've all talked about rates remaining higher, or at least moving higher. Maybe not as quickly as the dots suggest, but certainly moving higher. And next month we should get that next FOMC rate hike. But will that be the last? That's the big question. Secondly, we have the beginning of the G20 meeting. That's obviously going to be center and focus to pretty much everything that's happened over the last several months. It's going to be about trade between the U.S. and China. The volatility that's been created in the stock market and the bond market has really began and ends with trade right now. And I think that right now is going to be key as we move forward. And lastly, something that really isn't on the radar of the bond market as much, OPEC will meet. Certainly oil prices have been very volatile lately. That's another reason why, risk off trade, you may be seeing more flight to quality bid to places like the bond market. If we can find some kind of resolution there, some kind of calming of the oil markets, I think that would obviously help things in volatility speak. It certainly won't change the direction of yields at this point, but certainly I think would get people with their finger off the panic button. So right now the bond market continues to push yields lower. We haven't gotten through that critical 3% in the 10s, but the lowest weekly settle since middle of September means that momentum is starting to build, and next week FOMC minutes may push us over the edge.